This is Stephen Thomas with Reports on Housing. That is what I do. I'm a housing analyst, and I'm bringing to you the latest housing debrief. And this week, we're going to dive right into, can the Fed fix housing? And the reason I came up with this is because within the last couple of weeks, especially this earlier this week, prior to the Fed making their announcement, I got a lot of text messages. I got several phone calls as well. And people have been asking questions during my presentations, asking about the Fed rate cut. When they do cut, is it going to fix the housing market? And I need to let everybody, a lot of them were anticipating that they were going to be cutting rates this coming up this week. And we're actually recording this on August 1st. And on Wednesday, July 30th, they came out and said that they're not doing anything with rates for the month of July. It's very reminiscent of last year at this time, but wanted to dive into it. And so a lot of people were asking about these rate cuts, and I need everybody to understand this is going to be a bit of an education as well as to how mortgage rates, long-term rates work. And because there is a lot of confusion. So what happens when they cut rates? What's going to happen? So first, we're going to dive into the underworking of long-term 30-year mortgage rates. That's long stuff. That requires investors to invest in the long stuff. And so what ends up happening with rates is when the economy is looking really resilient and the overall economy shows positive numbers, with retail sales and everything looks extremely resilient. As a result, interest rates rise when these numbers come out. And interest rates rise because investors, they like the short-term stuff. They like stocks. And so they play in the stock market and they like overnight, really quick, fun stuff, the stock market. That's where investors like to play when the overall economy is looking really, really hot, looking good. But when the economy shows signs of cooling and that there's trouble ahead, that's when you see interest rates fall. And the reason that long-term interest rates fall is because investors, they like to go to a safe haven. They don't like the short-term stuff. All of a sudden, the short-term stuff doesn't look as good. They want the long-term investments. They're looking at 10-year treasuries and mortgage-backed securities. And there's this love affair. That's what this penguin love affair that goes back to when they first started tracking mortgage rates and 10-year treasuries all the way back in the day. So this goes all the way back to 1971. So there's this love affair between 10-year treasuries and mortgage-backed securities. So what ends up, that's more of the long-term stuff, 10 years. And the reason mortgage-backed securities, they like to look at mortgage-backed securities, it's not 30-year mortgages. It's really the average loan is held for 10 years. So they're wanting to diversify their portfolios. So they look at both 10-year treasuries as well as mortgage-backed securities. So when they're investing a lot in that, that's when rates fall because there's a lot of investment activity taking place in the longer-term stuff. And that's what happens when the overall economy cools. Now, the Federal Reserve, they are made up of a whole bunch of board members. And this is a picture of the Federal Reserve. And I want everybody to really understand this, that there are 12 voting members for rates. And when they're talking rates, they're talking the short-term federal funds rate. It's an overnight banking rate. It's not the long-term stuff, 30-year mortgages. It's an overnight banking rate. What's tied to this is more in line with credit cards, automobiles, automobile loans and equity line of credit, that type of stuff. That's what's tied to more of the shorter term stuff. So your credit card rate improves, gets better as the short term rate falls. But there are 12 members. There are 7 that are permanent, and there are 5 that rotate on an annual basis. And this is how they do it. It takes 7 out of the 12 in order for there to be enough voting members where you get either rates to rise or rates to come down or rates to stay the same. It has to be 7 out of the 12 to make make that happen. And matter of fact, even if you get 6 out of 12, rates just stay the same. They don't change at all. So you have to have a majority, 7 out of 12. And this week was the first time that we had two dissenting Fed presidents. It's the first time since like 1991. So over 30 years ago was the last time that you had two dissenting members of the Federal Reserve Board, where two members actually wanted the short-term federal funds rate to be dropped by a cut by 0.25%. But so that's the underpinnings of how things work. And I need everybody to understand that Jerome Powell's term, he's just one of the voting members. Now, his term ends in May of 2026. And he can stay on, but most Fed presidents, once they're done with their term, they typically leave and go do something else. So there will be a new Fed president that is installed by the Trump administration, and as a result, you will have somebody that's a little bit more on the yay side on bringing rates down. And so that's one person. Now you have two others that are saying, yes, we want rates to be cut right now. So that's 3 right now. That's still not that majority that everybody is looking for or calling for, because it takes like I said, a majority. You have to have 7 out of the 12 that state that we need rates to come down. So they meet every 6 weeks, and every other meeting is pretty important because it's pivotal. They talk about what they're going to be doing with rates, not only for the day, the short-term rates, but where they're going to go with their short-term rate over the course of the rest of this year, the following year, and even the year after that. Now, back in September, they said that there would be 4 rate cuts, and they changed their tune from September to, that's for this year. The September of last year, they said 4 rate cuts for 2025. Then in December, that was when they projected rates out again, because it's every other meeting, they said 2 for 2025. And then they met again in March and still said 2. And then they met again in June and still said 2. So that's where they're at. They're at 2 rate cuts, and this is by and large what the overall voting consensus is of all the different members that vote on this. And there's actually typically like 17 dots that they vote on where they think things should be going for the rest of the year, as well as the following year and the year after that. So as far as 30-year mortgage rates are concerned, this is the long-term stuff. When the Fed cuts rates, or when the Fed increases rates, typically what happens is on that day that mortgage rates, it's already banked, 30-year mortgage rates are already baked in the cut or the increase. So to take you back to September of 2024, when they reduced the short-term rate by 0.5%, that day, actually, we knew with certain volatility that we were going to get rates that were going to be slightly higher for the day. Yet everybody and their brother and sister and uncle all went and looked up rates that day. As a matter of fact, where we typically look for rates, I couldn't even access the site because everybody expected rates to be down 0.5%. On that day, rates were actually up a little bit. Couldn't find out exactly how much they were up until later on in the day, when there weren't as many people flooding the system expecting 0.5-point rate cut. Now, even if they do a rate cut in September, which many people are talking about, know that rates already moved to where they think that the Fed is going to be down the road. So the day that they cut or increase interest rates, long-term stuff, 30-year mortgages are already pegged to where they think the Fed's going to be. It's already articulated as to where they think they're going to go. And the Fed is they are extremely data dependent. And the U.S. economy, with all the recent data numbers, it's shown that the U.S. economy is very resilient, and as a result, there's not a giant appetite for the long-term stuff, the mortgage-backed securities and 10-year treasuries. So they've been trading in a very tight range, and we've had rates that have been pretty much stuck between 6.75% and 7% for a super long time. They haven't really budged much from there because everything has been rock solid. But now, as far as long-term rates are concerned, they just don't have that appetite. Until that is today. And today, we actually saw that that the jobs report came out, and the jobs report showed that there weren't as many jobs created as what they originally had anticipated, far fewer. It was supposed to be like 100,000 jobs, and instead there were 73,000 jobs created for the month of July. And this came out today, August 1st. It's the first Friday of every month. And what was more interesting were the two prior months were actually, they were cut by 250,000 jobs. They were revised. And for the month of June, it was down to like 13,000 jobs that were created, or 14,000 jobs created. And for the month of May, it was 17,000 jobs. So these were cut by 250,000 jobs, and it was looking a lot weaker than what the original job reports, headline job reports, had shown. And this actually shows that today, that the headline report is 73,000, and that is the Bureau of Labor and Statistics. It's the BLS. Now, I want everybody to understand that the head of the Bureau of Labor and Statistics was actually fired today by the Trump administration. And it makes a lot of economists actually scratch their heads, because everybody thinks that the numbers are all fudged, but they're constantly revised. And these revisions, they continuously happen, yet these headline numbers still move the markets to where they need to be. The revisions take place because of survey results have come way down, and it takes longer to get better numbers. And then by the time you get way out, they can actually cross-reference the numbers based upon tax rolls and things like that. So they get really solid numbers, and then they're revised again way down the road. And people think this is all political and it has nothing to do with politics. And this is just a knee-jerk reaction. It's actually, the data is fine. It's just the revisions have been mind-blowing, and that's because of the evolution of the way that data works. So hope this doesn't continue, that every time you see something you don't like, that people get terminated in the future, because we like our numbers, and even if they are revised, know that this is not politically motivated. And as far as the 10-year Treasury is concerned, I showed you that jobs report. It was way down. It was way cooler than what anybody anticipated. I knew when I woke up at 5:30 in the morning, I went to the 10-year Treasuries, and it was down by 0.144 in the red, down. And you can actually see on the right-hand side, it's down significantly for the day. And I knew that meant that rates were going to come down quite a bit for the day too. And that's what it was going to take. We kept on talking about the jobs market would eventually crack. This is when it cracked. It cracked just a couple days after the Fed met. It was very, very similar to 2024 when it did the exact same thing. And as a result, interest rates came down quite a bit. This says 6.83%. It's actually 6.63%. That's how much they came down from recently, down to 6.63% today. So it was a big dive. And I want everybody to understand that as of today, there is CME Group. This is actually a Fed watch. You can go here. You can actually go to CME Group and check their Fed Watch page. And this will show you that there's been a big change. Now there is a priced in an 86% chance that there will be a quarter-point rate cut in September. And you think, oh, well, that's not that big of a difference. But you can actually see that from this was the dark blue is the 86% chance. The right next to that, the light blue adjacent to that, that was yesterday. And the next light blue column over from the 400 to 425, that was 2 days ago. And the lightest blue on the right-hand side, that was 1 month ago. So you could see that over time that the odds of a September rate cut were coming down quite a bit. That's because of the resilient jobs reports and things like that, the economic news. And then we got today's jobs report, which was a big eye-opening jobs report. And you had this sudden sea change in what has occurred. And similarly, this is actually, if you look at this, this is for the month of December. And on the right-hand side, that's do nothing. And you can see that dark blue, you can barely see the column because most everybody thinks there's going to be at least one rate cut. And you can see that there is definitely, it's priced in for at least 2 rate cuts. And it's actually starting to be priced in for 3 rate cuts. And that is a brand new. And this is the sentiment. This is the overall economic sentiment from Wall Street. And this is, I go here a lot just to see what this sentiment is from Wall Street as to what they're thinking is going to happen with the Fed. And now all of a sudden, you're starting to see a larger chance of 3 rate cuts versus 2 just a couple of days ago. So you can see how quickly things change, and it just has to do with the data. Now, the Federal Reserve is probably too data dependent, in our opinion and in many people's opinion, and that makes them a little bit late to the party constantly. And hopefully that changes in the future, and they get a little bit out more in front of changes. Now, as far as the White House and the administration is concerned, they want to see that the federal funds rate is cut by 3%. Now, what I just showed you is 3 rate cuts of 25%, which is down 75 basis points. So 3/4 of a point, not 3%. And they want to drop from 4.5%, where it is today. And remember, this is the short-term rate. These aren't long-term rates. Down to the federal funds rate, down to 1.5%. Now, if you see where we are and where we have been in time, this is as of this Wednesday. They stuck at 4.5%, and it's been stuck at 4.5%. Now, the projection for the rest of the year are those green dots below, and you can see that's 2025 for the rest, and then 2026, and then into 2027 they're talking about coming down further. Now, as far as the where the administration wants it to come down to is all the way down to this yellow line, and that's not going to happen, because even if the Federal Reserve starts cutting, they can't cut aggressively. The Wall Street, as well as economists, they all agree that you can't come down instantaneous, that you have to see it in the data. There has to be an excuse for coming down lower in the federal funds short-term rate. Because if they came down all of a sudden, it would be a red alert. It would definitely be, there would be red sirens all over the place. There'd be a lot of people talking about it, because if you came down that fast, now all of a sudden you're juicing the economy, and you're putting a lot of juice into the economy. There would be, you bring down rates quite a bit, and now it makes money a lot easier to flow, and there's a lot more investment. And if there's a lot more investment, all of a sudden what you get is it's very, very inflationary. And remember, the Federal Reserve's dual mandate is maximum employment, which we're starting to see cracks in employment, but it's also keeping a lid on prices. And they still have some concern with tariffs leading to further inflation. And PCE came out earlier this week, and it was a little bit higher than what was expected, but nothing really too mind-blowing, that's for sure. But they want to make sure that they do this in a methodical way. And so what kind of a rate are we looking for? I used to say that we want to see rates in the 5s. 5s would be absolutely like this wonderful place to be. We had to be at 5.5%. But now we're in August, and the last time we had interest rates in the 5s was actually 3 years ago. So it's been such a long time ago that it won't take us getting all the way to the 5s for it to reignite the housing market. And what have I been praying for? What have I been going to church on Sunday and getting down on my knees praying for? I've actually been praying for 6% interest rates. That's the new golden interest rate as far as I'm concerned. A year ago, which is just 24 months out from the last time we had interest rates in the 5s, we actually had interest rates that came down to 6.1% for a week. And as a result, they were actually below at 6.5% or below for 47 days. And those were glorious days for housing, because we actually saw in the fall, for the first time since I've been tracking, we actually saw a big bump in demand. We saw some markets had a 10% bump in pending sales activity in a very short period of time. And it had everything to do with interest rates falling below 6.5%. and staying there between 6 and 6.5% for just 47 days. Now, if we were there for duration, that would create a big, considerable difference. The first thing would be a major improvement in home affordability. Now, the reason I don't want to go into the fives is because we need to take baby steps to get down into the fives. If we went down to the fives immediately, there would be a lot of millennials and Gen Zs that would be bumping into each other in the entry-level price ranges, and they would start competing against each other, and then we would have a problem of all of a sudden bidding wars and things like that. That's not where we want to be. I want to get there in baby steps so that we do it methodically in an orderly fashion. So 6% is where I want to be. So that's pretty much what I have for you for this kind of for this housing debrief. And if you want more information, you can go to reportsonhousing.com and you can subscribe to many of our different reports. We have reports that dot all over SoCal, the Bay Area, as well as Phoenix and Vegas. And the most recent report that came out is called The Wait. And that's because there's a lot of sellers out there that are waiting. It's a good time to be a buyer right now, especially with rates coming down to their best point so far this year, other than the initial tariff tantrums of going down and then going up. So if you want a free month, utilize the coupon code FED. And so that's what I have this week for the housing debrief. I just want you to know that once we get to that 6% level, that we'll see those jumps in demand. It won't be crazy, and then we won't see that. We won't see with the increase in demand, we won't see supply grow as much, and as a result, we won't see prices drift down like they are in so many markets across the United States. But this is one of those things is, when is this going to happen? We don't know exactly when, but we're taking steps in the right direction where we're at least getting 2 rate cuts. Most likely right now, it's looking a little bit more tilting towards 3 rate cuts, but we'll have to see where more of the data comes. Prior to them meeting, there will be another jobs report, because the next time they meet isn't until 6 weeks out, which is in September. And we'll have another jobs report so that they have another economic number for them to go by. So that will paint the picture maybe for a 0.5 point rate cut and another 1/4 point rate cut later on in the year. Thank you for joining us for another housing debrief. Hope you had an educational opportunity here and learned a lot about what's going on in the market. I'm all about setting expectations. I hope you have a great weekend, and we will see you on the other side.